Welcome. Every business has a finite life under its current ownership. Whether you sell to a third party, hand over to family, sell to your management team, or simply wind down at retirement, the day you step away will come. And it's an event worth planning for, well in advance. In this video, we'll walk through the key financial and tax considerations of business succession, including the powerful small business CGT concessions. I'm from the advisory team at Quantum House Australia, accountants and tax advisors. Here's our plan for the next quarter of an hour. We'll start with why succession matters and why it has to start early. We'll look at your exit options and how to value your business. Then the centerpiece for most owners, the small business CGT concessions, followed by how to structure the sale itself. We'll cover the special considerations around family transfers and managing key person risk. Walk through a short real-world example, run through the common pitfalls, and finish with the key takeaways and how we can help. Let's start with why this matters so much. Every owner exits eventually. That part isn't optional. What is optional is whether you plan for it. And the difference between a well-planned succession and an unplanned one is not small. It can be measured in hundreds of thousands or even millions of dollars. That difference comes from a higher sale price, a better tax outcome, and a smoother transition that protects the value you've spent years building. The single most useful mindset shift I can offer you in this video is this. Succession is not an event that happens at the end. It's a process that starts years before. That brings us to timing, which is the most common place owners go wrong. They treat succession as something to deal with when the time comes. But almost every strategy that maximizes the value of a sale or transition takes years to put in place. Some of the tax concessions require assets to have been held for a minimum period. You simply can't manufacture that at the last minute. Improving the value of the business, growing earnings, reducing reliance on a handful of big customers, reducing dependence on key people, takes time to take effect. And the documentation and governance that serious buyers expect to see takes time to establish. So, ideally, succession planning should begin at least 3 to 5 years before your anticipated exit. The earlier you start, the more levers you have to pull. Before you plan, it helps to be clear on the route you're taking because each one has different implications. The first is a sale to a third party, an external buyer. The second is a transfer to family, passing the business to the next generation. The third is a management buyout, selling to the leadership team who already know the business inside out. And the fourth is a gradual wind down at retirement. Each of these carries different tax consequences, different value considerations, and, in the family case especially, different emotional dynamics. The point is that the plan should come first. The structure follows the goal, not the other way around. Whatever route you choose, you can't plan an exit without knowing what the business is actually worth. And that means a formal valuation, not a gut estimate. Most small businesses are valued on a multiple of earnings, either EBIT, earnings before interest and tax, or EBITDA, which also adds back depreciation and amortization. The multiple itself varies with your industry, your growth rate, and how risky a buyer perceives the business to be. 3 things matter here. Knowing your current valuation, understanding the key drivers that move that multiple up or down, and seeing clearly the gap between where you are and where you need to be to fund the retirement you want. That gap is the starting point for the entire plan. Now to the part that often makes the biggest financial difference, the small business CGT concessions. These are among the most generous concessions in the entire Australian tax system, and they're designed specifically to help small business owners transitioning out. But, and this matters, you have to qualify. To access them, you first need to satisfy what the law calls the basic conditions. Broadly, that means your aggregated turnover is under $2 million, or your net business assets are under $6 million, and the asset you're selling is an active asset, one used in carrying on your business. Meet those conditions, and up to 4 separate concessions open up to you, which we'll go through right now. There are 4 concessions, and the real magic is that they can be used in combination. The first is the 15-year exemption, the most powerful of all. If you've held the asset for at least 15 years, and you're 55 or over and retiring or permanently incapacitated, the entire capital gain can be disregarded. Not reduced, disregarded. The second is the 50% active asset reduction, which halves the assessable gain. The third is the retirement exemption. A lifetime limit of $500,000 of capital gain per individual can be exempted. And if you're under 55, that exempted amount must be paid into superannuation. The fourth is the small business rollover, which lets you defer the gain by rolling it into a replacement active asset. Used together and with the right advice, these can dramatically reduce, and sometimes completely eliminate, the CGT on your business sale. How you structure the actual sale matters enormously, and there's a genuine tension here between buyer and seller. A sale can be done as a share sale, where the buyer acquires the shares in your company, or an asset sale where specific assets and liabilities are transferred. As a seller, a share sale is generally preferable. The small business CGT concessions apply, and the company's tax history simply transfers to the buyer. Buyers, on the other hand, often prefer an asset sale because they get a clean tax base and can pick exactly the assets they want, leaving behind any they don't. Neither side is right, but the negotiation between these two positions can significantly affect the final purchase price, so it pays to understand the trade-off before you go in. Transferring a business to family deserves special care because it blends tax with family dynamics. A transfer at undervalue, say selling to a child below market value, doesn't escape tax. It can still trigger capital gains tax and stamp duty, and those are generally calculated on market value, not the price you actually charged. If the business operates through a company, you also need to watch for Division 7A issues, which can turn what feels like a simple family arrangement into a deemed dividend. Gifting arrangements need to be structured carefully, and while gift duty is no longer levied federally in Australia, you still want to preserve access to those valuable CGT concessions. And family succession should always be backed by formal legal documentation, a business transfer agreement, updated shareholder agreements, and a review of everyone's personal wills. Handshake deals between family members are exactly where succession plans come unstuck. Here's a lever that's often overlooked, and it can move your valuation more than almost anything else. Key person risk. One of the biggest discounts a buyer applies to a small business is for key person dependency, where the success of the business rests heavily on the founder or one or two key individuals. The buyer's fear is simple, that the business will deteriorate the moment you walk out the door. The good news is that this is fixable with time. In the 2 to 3 years before a planned sale, you can systematically reduce that dependency by building a capable management team, documenting the processes that currently live in your head, and deliberately transitioning customer relationships across to your team. Do that, and you lift both the valuation and the buyer's confidence at the same time. Let me tie this together with a short hypothetical example. Picture Margaret and David, fictional co-owners of a specialist engineering firm they'd run together for 18 years. At 58 and 60, they hoped to retire within about 3 years. A succession review surfaced 2 problems early. First, the business leaned heavily on David's personal relationships with key customers. Textbook key person risk that a buyer would discount hard. Second, they'd never had a formal valuation, so they had no real idea of their starting point. Over the next 2 to 3 years, they acted on both. They built and empowered a management team and deliberately moved client relationships across to it, which lifted both the multiple and buyer confidence. They got a proper valuation, which set a clear target, and they structured the eventual deal as a share sale, so the small business CGT concessions could apply. Because they'd held the business well beyond 15 years and were over 55 and genuinely retiring, the 15-year exemption was available, and the capital gain was disregarded entirely. All told, the difference between a reactive sale and their planned, well-prepared exit was estimated in the hundreds of thousands of dollars. The lesson is the one we started with. Succession is a process, and the years before the exit are where the value is made or lost. Illustrative only, of course, but very real in its logic. Let me gather the main pitfalls because they're remarkably consistent. The first and most expensive is leaving it too late. Concessions and value improvements both need years, and a rushed exit forfeits most of the upside. The second is never getting a formal valuation, so you're flying blind on the one number that matters most. The third is unmanaged key person dependency, and the single discount buyers apply most aggressively. And the fourth is informal family deals, undervalued transfers that trigger CGT, stamp duty, or Division 7A, because they were never properly structured. Every one of these is avoidable, but only if you start early enough to actually do something about it. So, to bring it together, succession is a process. Start 3 to 5 years out. Get a formal valuation so you know your number and the gap to your goal. Understand the small business, CGT concessions. Used well, they can be transformative. Remember that share sale versus asset sale materially affects both price and tax. Family transfers need careful structuring and proper legal documents, and reduce your key person risk to protect and lift your valuation. Get those right, and you give yourself the best possible exit. This is where Quantum House Australia comes in. We work with business owners at every stage of the succession journey, from early value improvement strategies through to exit structuring, assessing your eligibility for the small business CGT concessions, and planning your finances for life after the sale. Our outsourced CFO team can also run the due diligence process on your behalf, so you go to market prepared and professionally represented rather than scrambling. And because succession leans so heavily on legal documentation, transfer agreements, shareholder agreements, wills, and can occasionally become contentious, we draw on our colleagues at Australian tax experts, tax advisors and lawyers, so the accounting and the legal side together in one place. So here's the thought to leave you with. The best succession outcomes are built years before the exit, not negotiated in the final months. Wherever you are on that journey, even if your exit still feels a long way off, the time to start shaping it is now. Quantum House Australia offers a confidential succession planning consultation. Visit quantumhouse.com.au or call our Sydney office on 1300 809 697. Thanks for watching. Quantum House Australia, accountants and tax advisors, setting a new standard.